Good day to you. Here again is Finance for Earn, and I will guide you through your money journey. Today we're tackling one of the biggest questions in the investing world right now. Should you buy index funds now, in an overvalued market? If you've been keeping an eye on the stock market, you know it's been a wild ride. Prices are soaring, and it seems like everyone is talking about an overvalued market. But what does that mean for you and your investments? Hit that like button if you're amped for original thinking tips, and do not leave so that you can be the first to be informed with our new episode video notifications through ticking the bell icon and subscribing. To get down to brass tacks, let's start with what index funds are. Index funds are a subtype of a mutual fund or ETF developed to simulate the performance of a defined market index, for instance, the S&P 500. Unlike hedge funds, which want to outperform the market, index funds are geared to be at par with it. The concept of the index fund was popularized by Jack Bogle in 1976 when he founded the Vanguard 500 Index Fund. Bogle's idea was simple yet revolutionary: provide investors with a low-cost, diversified investment vehicle that tracks the market's performance. Index funds have since become incredibly popular due to their simplicity, low fees, and consistent performance, making them a favorite choice for both novice and seasoned investors. Now, let's take a look at the current state of the market. Many analysts and investors believe that the market is overvalued. But what does that mean? There are several metrics used to determine market valuation. One popular measure is the price-to-earnings (P/E) ratio, which compares a company's stock price to its earnings per share. Another is the Shiller P/E ratio, which adjusts for inflation and earnings fluctuations. Additionally, the market cap to GDP ratio, often referred to as the Buffett indicator, compares the total market capitalization to the GDP of the country. Right now, many of these indicators suggest that the market is trading at higher than average valuations. Now, let's delve into the wisdom of Jack Bogle, the founder of Vanguard Group and the pioneer of index fund investing. His philosophy has transformed the way millions of people approach investing, especially in turbulent times like these. But what exactly did Bogle believe? And how can his principles guide us in today's overvalued market?
It seems to me that speculation, betting on higher and higher valuations, is in the driver's seat. Investment, betting on the fundamentals of dividend yields and earnings growth, is in the back seat, probably even in the rumble seat. But when speculation drives stock returns in the short run, while it drives stock returns in the short run, it's the crystal clear lesson of history, at least the past 200 years, that in the long run, fundamentals drive return.
Bogle's main tenet was simple: low-cost, diversified index funds outperform most actively managed funds over the long term. He believed that by owning a piece of every major company in the market, investors could benefit from the overall growth of the economy without having to pick individual winners. Don't look for the needle in the haystack. Just buy the haystack. Jack Bogle by this. Bogle meant that trying to find the next big stock is incredibly difficult and risky. Instead, owning a broad index fund that includes all the stocks in the market reduces risk and increases the likelihood of steady returns. Another cornerstone of Bogle's philosophy is the importance of keeping investment costs low. He argued that high fees and expenses can significantly erode your investment returns over time. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs. This means that every dollar you save on fees is a dollar that continues to work for you, compounding over time and boosting your overall returns. Index funds typically have much lower expense ratios compared to actively managed funds, making them a cost-effective choice. Bogle also preached the value of a long-term perspective. He believed that the best way to achieve financial success was to stay invested and not be swayed by short-term market fluctuations. Time is your friend. Impulse is your enemy. In today's overvalued market, this advice is particularly relevant. It's easy to get caught up in market hysteria and make impulsive decisions. However, Bogle's philosophy reminds us that sticking to a disciplined, long-term investment strategy is the key to weathering market storms and achieving sustainable growth. Lastly, index funds are ideal for long-term investors. The power of compounding returns over time can significantly grow your investment, and by staying invested, you can ride out market volatility and benefit from the overall upward trend of the market. Pros of buying index funds now. One of the major benefits of index funds is diversification. By investing in an index fund, you're essentially buying a piece of every company within that index. This reduces the risk associated with investing in individual stocks. Another advantage is cost efficiency. Index funds generally have lower expense ratios compared to actively managed funds. This means more of your money is working for you, rather than being eaten up by fees. Lastly, index funds are ideal for long-term investors. The power of compounding returns over time can significantly grow your investment, and by staying invested, you can ride out market volatility and benefit from the overall upward trend of the market. Cons of buying index funds now. Overvaluation risk. However, there are some cons to consider. Buying into an overvalued market means you could face short-term losses if the market corrects. It's important to be prepared for potential downturns. Short-term volatility. Index funds, while generally safer than individual stocks, are not immune to market volatility. Short-term fluctuations can be unsettling, especially if you need to access your funds in the near future. Alternative strategies. For those wary of current market valuations, alternative strategies could include investing in bonds, real estate, or holding more cash to take advantage of potential buying opportunities in the future. Bogle's advice for current investors would be to stay invested. He believed that time in the market was more important than timing the market. A great strategy is dollar-cost averaging. This means regularly investing a fixed amount of money regardless of market conditions. This approach can help mitigate the impact of market volatility and avoid the pitfalls of trying to time your investments. Maintaining a balanced portfolio is also key. By diversifying your investments across different asset classes, you can manage risk and ensure more stable returns over time. To sum up, while the market may seem overvalued, the principles championed by Jack Bogle suggest that staying the course with index funds can still be a wise strategy. Diversification, low costs, and a long-term perspective are your allies in navigating market highs and lows. Personally, I believe that consistent investing in index funds can provide steady growth over time, despite market valuations. It's all about having a plan and sticking to it. What do you think? Are you investing in index funds right now? Let us know in the comments below. Don't forget to like, share, and subscribe for more investment insights.